Welcome, everybody. I'm Richard Rosso, Certified Financial Planner, here with Danny Ratliff, also Certified Financial Planner, and we are so appreciative of you being at our webinar today, The Post-COVID World and Your Money. Smart money decisions for the Great Reset. There's a reason why Danny and I call this the Great Reset. It's a reemergence of how you look at money. It's a reemergence of how you need to consider planning in your household. Listen, there's some bad stuff. We've all seen it. Some of us have gone through it, but there is light on the other side. But it will require reinvention and just thinking about things differently, right, Danny? And we want to make sure people are prepared for what the world looks like as we come out of this overall.
You know, it's one of those things where many times we're thrust right into making a decision, and unfortunately, many times we're not prepared. And so our hope today is that you guys learn a little bit about how to make some of these decisions, just arm you with more tools moving forward on what you can do to protect your family and your household.
Keep in mind, this is one of a series, as we will have additional webinars to help you work through and manage in your own household the Great Reset.
So RIA Advisors is essentially Clarity Financial. We're doing business as RIA Advisors. We are a registered investment advisor with the Securities and Exchange Commission. And why that's important to you, it means we are a fiduciary. So we don't take that responsibility lightly, and we hope you guys don't either.
Listen, we understand that change isn't easy. And I was looking for the right quote to share with everybody, and I thought this was perfect. Inevitable, not always controllable. But what can we control is what we manage, react to, and work through when it comes to the change process. We have gone through two very large structural breaks in the economy. The financial crisis, right? The Great Recession, and now COVID or the Great Reset. And unfortunately, this is another structural break on top of a previous structural break. So we want to make sure that you understand that you need to embrace change. Some of it thrust upon us. Some of it we need to be proactive about, and that's what this webinar is about. So there are three areas that we'd like to cover. So you're underemployed. What do you consider here? Did you receive a severance package? Will you receive a severance package? And is the bear market over? Realistic perspective from our chief investment strategist, Lance Roberts. But first, not that we need to go through all of the state of the economy, but Danny, obviously it's pretty dire out there. I am calling it a sort of a period between the Great Depression and the Great Recession. It's right up there with some of the worst economic numbers we've experienced in our lifetime.
Economically, data just looks terrible. And unfortunately, by the week, we continue to get more rolling in that's looking bleaker and bleaker. And I don't know what we expected. The economy shut down globally. Mm-hmm. And so we have to be very mindful that we just don't flip a switch and turn things back on. But this slide, we hope to give a little bit of perspective, kind of looking at real GDP, gross domestic product. So just to put that in context, in the Great Recession, that was down 4.3%. Unemployment was as high as 9.5%, peaked at 10%. We're already well off those numbers. We're a much worse scenario. And unfortunately, these jobs are likely not just going to come back, which is the reason for this workshop, to help empower you with making good decisions. So GDP is at its worst was 4.3. Now we're already at 4.8 negative. We've had a pretty big contraction there, Rich.
And we sure have.
That's something that's not normal.
And it's tough to wrap, as humans, it's tough to wrap our brains around these numbers and the devastation. We are a consumer-driven society, and we have literally cut off consumer spending at the knees. Therefore, these numbers will continue to get worse, and then they'll base, and then they'll slowly improve. So new jobless rates are still surging, and obviously there'll be a point where these numbers sort of bottom out, and we start to recover. We are a consumer-driven society, and we have really cut the heartbeat of our economy. The issue becomes, how do we reemerge? Habits have changed. How people work that's going to change. How people reset their priorities, that's going to change. But when it comes to these jobless rates, they're going to continue to increase. And again, we're going to have to wrap our arms in our everything. Well, let me take that back. Yeah, we're going to have to wrap our brains around these jobless rates, right, Danny?
Yeah, and that's the thing that it's very difficult to keep in context because these rates don't include a large percentage of the population have just been, they're underemployed. You know, that first talking point is one that I think is very misguided or maybe not talked about nearly as often because, you know, if you have a job, you're just thankful to have one. But think about the consumer spending on the other side of this, you know, just like you talked about with GDP, that's going to be a major hit.
Well, and when you have jobless rates that last as long as they probably are going to do this, you brought it up earlier, turning on the economy, it's not like a light switch to turn off and turn on. It's going to take a while. Think of it like a dimmer where you're going to slowly turn the lights back up. Households are going to be increasingly damaged here. Therefore, they're not going to be spending at the rate that they were. It might take years. It might take a decade for us to go back to where we were. And that's unfortunate. But this is the Great Reset and the new reality.
So what is the Great Reset? Essentially, we believe this is a reevaluation on how we move forward. What's important in life, Rich? I think that this time at home has changed people fundamentally and how they view the world and view themselves. And I hope in a good way. You know, hopefully they've cherished experiences more than material things. We can go down a rabbit hole here. But what I think inevitably this ends up looking like is that what does your employment look like? You know, and I tend to take a different stance than many. Yes, this is a difficult time for so many at this moment. We talk to people who are losing their jobs. Like many people are impacted. But it's also a glass half full. You have that reset to reinvent yourself. Mm-hmm. You know, what does that next step in life or stage in life look like? You know, you can reevaluate your skills. You can reevaluate, you know, your housing, your expenses, your finances in general. You know, there's a lot of things that may change for quite a bit of time. You look back to what we talked about a bit ago, the Great Recession. We saw employer matches just completely go away. Mm-hmm. And they didn't come back quickly. No. You know, it took years for employers to come back and say, okay, we're going to start matching again. Wage growth. We just started seeing wage growth about 2 years ago. And so this is going to be that time for households to reevaluate, figure out where they're going to go next, and what is that next iteration of you. Like we talk about for people going into retirement, well, guess what? Now things are moved up where you do have that life-changing event, and you do have many, many different options out there.
These are tough. This is a tough reevaluation of how we all do business, how we maintain household finances. There are some tenets that we've talked about here at RIA for years, Danny and I, and on the radio. But now, if you've done some of these things, and we hear from people who have, you're in better shape. We never thought it would be a virus that would cause this. However, regardless of the catalyst, there are households that listen to us and are in better shape, but it's not too late. So there are going to be questions that you're going to continue to need to ask yourself. As Danny said, employer matches on company retirement plans postponed. There are studies out recently that show at least 23% of businesses are going to cut matches on their employer contributions. And guess what? There's no visibility as to when they may begin those again. This financial vulnerability that leads to not this short term, we'll get through it, but long-term challenges and strains to your budget. What about your skills? Are there some core skills that you need to bone up on? Do you need to increase? Do you need to change? This need to reinvent, maybe, to Danny's point, as a glass half full. And I've heard from individuals that have been kind enough to share with me that they're saying, you know, I've always wanted to do this. I always wanted to make the change, but I got too comfortable. This gave me the ability to do it. I really thought about it. I have individuals that I've talked to that have created whole new business plans for new companies through this process, you know, overall. So again, we'll go through this. What are we hearing at RIA so far? Here's a few of the comments. There are, listen, hundreds of similar comments. I just wanted to give you the common threads, the comments that are rising to the surface. And keep in mind, if your salary has been reduced, or you thinking about working a side gig, you are indeed underemployed. The one thing, Danny, I'm hearing is people are telling me, well, no, I got this 10% cut, but, it'll be back. I'll get that 10% back. I said, well, did your employer actually tell you that? No, I'm making an assumption. It's a bad assumption. I need everybody on this webinar to reset their lives to this cut, because this is probably it. This is probably no going back. Hey, if you are one of those people where a company turns around in a few years and says, hey, here's your 10% back, I'd love to hear from you. From the experiences I've had through the Great Recession, those cuts became permanent. I don't see any reason to change that opinion now. What about you, Danny? What do you think?
I agree. And 10% is actually on probably the better side. I'm hearing much worse,
me
many
too.
stories of
Yep.
20, 30, 50% pay cuts. And, some of these things are where we do have to reevaluate household finances. Do you say, okay, you know what? Let's start, reining in some of these expenses, cut subscription payments, those things that we automatically set. That could be a first place to go. Get rid of vehicles that you're not using, or if you have an extra one. Do you downsize your home? I mean, there's so many different things, and we could go on and on and on about this. But one thing we don't want you to do is think that, okay, you know what? I'm going to pull out a savings. I'll keep everything as is, because we're going to get back to normal quickly. And look, I think we'll get back to some normalcy. I just don't think it's going to be as quick as what you would expect. And think about how long it took you to earn that retirement fund, the funds you have in the savings, those emergency funds, which are there for times like this. But what if it got worse? What would you do? And I want you guys to think about this a little bit differently and just say, well, what if it doesn't get better? Let's play devil's advocate and go ahead and start protecting yourself, because guess what companies are doing? That's exactly what they're doing. So you need to treat your household just like a business does and says, hey, we need to trim the fat here. We need to go ahead and trim expenses. We need to make sure that we can meet our general expenses that we have without maybe the extra things that we've typically done. That's what you need to do yourself.
It's important for everybody to understand the CARES Act, and the reason for it is I do believe that the CARES Act is going to be with us a very long time. Much like the Roosevelt program in the 30s, I think what President Trump and Congress have created is a social safety net that will most likely be with us indefinitely. I don't know if this element will, but many elements of it will absolutely be. But we want to help you understand, from your perspective, a household finance perspective, what you need to know about the CARES Act. So there's an immediate impact to your retirement account distributions, or the ability for you to withdraw without a 10% early withdrawal penalty. Danny knows I was very much passionate about having changes to early withdrawal penalties through this crisis, only because I saw the financial death spiral that people went through when they were trying to eat and pay their rent and mortgages through the financial crisis, and getting hit with not only taxes and the 10% penalty, which was more of a financial hemorrhage at a horrible time. So even though you don't want to take money out of your retirement account to survive, or we're underfunded, most of the households anyway, but listen, you have to eat. You want to pay your mortgage. You need to pay your rent. At least you don't have these taxes and penalties to really harm you even more. So I am positive for this part of it. But again, not for discretionary spending, right? The fun stuff. This is for the needs. This is the stuff that's going to keep you alive. That's what you want to take into account if you're going to withdraw from your retirement accounts. We wanted to lay out for you some of the rules as a guideline if you're considering distributions, right?
And I think it's very important that this is an opportunity as well. So, like you mentioned, we don't want to use these funds on just discretionary expenses. But this is also an opportunity to go ahead and take funds out of these shared accounts with Uncle Sam, meaning that every dollar you take out is taxed or penalized. But this could be a great opportunity to do a Roth conversion. It could be a good opportunity to move funds aside while maybe income is lower. With all of this stimulus, this is something that we feel very passionate about. The taxes are likely going to go higher at some point. And so this could present some opportunities in that regard. Now, everybody wants to know what one of the key things here within this act is that it suggests that you have to have been impacted by COVID-19 to make this distribution. Right. And impacted, I think, is a number of different ways you can look at this.
The definition, to your point, is a very good point.
Very vague.
Rather vague, rather expansive. I don't really know how the IRS is going to check on all this, but listen, if you've been underemployed, someone in your family is, that's a virus-related challenge, right? I mean, if you've got an impact to your household financial budget because of this virus, then you absolutely are able to take advantage of this element of the CARES Act.
And what I hear, it's going to be difficult for the IRS to prove and come back, and likely they're not. But I would suggest speaking with your CPA. It's kind of expected that over the summer, we're going to get a little bit more clear verbiage on the legislation.
We will. It'll come. I'm getting questions from individuals about, hey, listen, I want to do this, even though they have no virus-related challenge, and I want to do an elective surgery, or I want to pay off my credit cards. And I'm like, listen,
no, don't
do it because, again, I don't know. Is it possible for you to take money out of your... First of all, I would not be taking money out of my retirement account to do an elective surgery, okay? Something that's going to make me look prettier. I'm not going to do that, right? But the point is, we don't know. To Danny's point, this is fluid. There'll be more clarity as we go through. I understand withdrawing amounts are taxable over 3 years. If this crisis lasts longer, could it go longer? Absolutely. This CARES Act is going to morph, change into something different, but it will be with us for a very, very long time. There's also, in this CARES Act, relief for student loan borrowers, whether it's employers that can contribute tax-free for tuition assistance, or what kind of relief are you going to get for federal student loan borrowers, right? Direct loans, Perkins, federal family education loans. They're also going to suspend not only monthly payments, but what was unclear was whether or not interest was going to accrue, and it is not. If you're taking a private student loan from a private entity, family member, that kind of process is not included in the CARES Act.
There's also a temporary increase in the amount you can take out on retirement account loans. So historically, it's been from a 401k, 401a, 403b, or government plans, you're limited to either taking out the lesser of $50,000 or 50% of the balance that you have vested. Now that's actually going to increase. They're going to double that. So now you can take out the lesser of $100,000 or 100% of the vested account balance. Now, this is kind of a neat deal in the sense that it's going to give you more flexibility. But just like we talked about with the element of taking funds out of the retirement plans like an IRA, this should be very thoughtful on how it's paid back. You generally have that 5-year window. You just have to be cautious here and not use these funds frivolously. That's the number one thing that I could say here.
Everything you do, whether it's a retirement account loan, distribution, it's because, hey, we've got to keep the lights on, we got to feed the kids, we've got to pay the mortgage, and we don't have an adequate emergency reserve. That's when you want to do this. Say you had an outstanding loan and you do have a COVID related challenge, right? And you have repayment due between March 27th and December 31st. You can delay your loan repayments for up to a year, although interest will continue to accrue on these delayed payments. Remember, this is for people that have already had a loan pre-COVID.
Another important feature that the federal pandemic unemployment compensation program is offering is an additional $600 on top of your unemployment compensation. So this is really nice in the sense that they're hopefully giving a little bit of a leg up in the sense that your income will not be hit nearly as bad. These benefits have been extended by all states for 13 weeks.
Also important, you're expanding the eligibility to non-traditional workers. So if you're a gig worker, independent contractor, self-employed, originally you would have not been eligible. Now you are. This is the part, and everybody will hold me to this, including Danny, but this is the part of the CARES Act that I think goes on indefinitely, Danny. I think we're in for chronic structural underemployment for many years. I think this FPUC program is going to be the one that never goes away, at least over the next decade. We'll have to see, but I think this kind of support is going to be necessary as businesses go through the Great Reset themselves, maybe need less employees. And listen, these are trends that have already been in place. Now companies are going to take this to the next leg. So while you reinvent yourself, you might really need this FPUC program much longer than realized.
You know, Rich, I think you're right, but I hope you're wrong.
I hope I'm wrong as well. What about severance? Listen, in the pre-COVID world, this was a different decision. Maybe now people don't get severance. If you're one of the fortunate ones that will in this Great Reset, we want to make sure you understand how they operate. And the first thing that you need to consider is the emotional impact. There's an emotional process to this. And I think maybe pre-COVID, it was more because you've been placed suddenly in a situation where there's a dramatic shift by the virus. So you might already be primed for this. But I still think that there's an emotional element to any kind of move like this. And I think you have to, it's been tough, even through this process, to put emotions on the back burner until a financial decision is made. In many cases, you would have 21 days to do your homework. You may not have this luxury. Now, I had someone that just got a severance package. He needed to make a decision in 5 days. And we went through it together. So this is where you want to bring in an objective financial partner to go through this with you. You need to thoroughly understand the severance agreement. If there's a non-compete clause, these are another thing that bothers me. I think these non-compete clauses are draconian, and it prevents many people from returning to the workforce. I'm very interested to see what these look like now. So you have to take that into consideration as well. If anything, you might say, listen, I'm out of this industry anyway. This is part of my Great Reset. But for most of you, it may not be. And that's where you need to really understand, maybe even bring an attorney in to understand this non-compete element to your severance.
Yeah, I think this is the biggest thing that concerns me is that somebody making a rash decision, not making one that's emotionally sound. You know, typically when we're already stressed, you know, we tend to do the easiest thing and just say, forget it, I'll figure it out later. Don't do that. Like Rich said, take that objective advice. I think that's going to be extremely important to make sure you really understand all the options and what the long-term implications will be for you. One thing to consider is what's your timing for severance pay? Sometimes, in some instances, they will give you the ability to actually spread that out over multiple years. If you have that ability, it's likely going to work in your benefit because we don't want to have to take one large lump sum that could potentially push you into a higher tax bracket, trigger additional capital gains. If you're over 65, you could also have Medicare surcharges on your premiums. This is where you want to consult with your CPA or tax advisor, your financial partner, and your HR department to see what type of flexibility they may have there. Because this can make a lot of sense and save you quite a bit of dollars on the backside.
Listen, hey, but you might need the money, right? So
You
this
may.
might not be a big deal for you. But if you've prepared properly and you're able to ask the question, we just wanted to make sure that it's something that you considered.
This slide talks about one of my favorite accounts out there, the health savings account. Now, unfortunately, not everybody has one because you have to be in a high deductible medical plan. But if you do have the ability to contribute to an HSA, those funds are going to go in pre-tax. They're going to grow tax deferred. And if used for qualified medical expenses, they're going to come out tax-free. This is the only account in the world that's going to give you that triple tax benefit, which is pretty awesome if you ask me. Now, the contribution limits are rather limited, meaning that in 2020, a family can contribute up to $7,100. An individual can contribute up to $3,550, and if you're over 55, you get $1,000 catch-up provision. Now, you do have to be cautious if you're using one of these plans. You're close to Medicare age, because you will want to stop these 6 months prior to you signing up for Medicare. But all in all, this could be a great tool. This could be a way for you to put funds aside, let these funds grow, and reduce your overall taxable income right now.
This is very important. If you're going to sit with a broker, generally speaking, and you have a pension with your company, they're going to tell you to roll it over. 100% of the time, roll it over. I will tell you that is not always the most appropriate choice. Danny and I are very, very concerned about guaranteed income for your family throughout retirement, especially if returns on stocks may not be what we need them to be. You need to meet with an objective certified financial planner to weigh it out. We always, Danny and I, look at the viability of the pension, your current age, your health, family longevity, leaving a legacy. Most important, the current state of your finances, to decide whether or not you need to keep the pension option to complement Social Security. This is not always a plain and simple decision. It's not always lump sum.
This is not a one-size-fits-all. This is something that needs to be customized for strictly you and your family to determine the best road forward. And you need to look at the solvency of the plan, the company. You need to look at your longevity. What's your life expectancy of you and your spouse? If something happens to you, will that payment go on? What type of flexibility? And, one thing I think is important. A lot of times, most advisors are going to say, do the lump sum, roll it over. We need to look at the internal rate of return, but you also need to know yourself. And what I mean by that is that what are you going to do if you have a large lump sum sitting in an account that you didn't have access to before? And I've met with many, many people, and Rich, you can likely attest to this as well. We visit with people day in and day out, and sometimes they get their hands on these funds. And it is a little bit more difficult for many to use self-control. And so if you know yourself and you're more likely to go out and spend, maybe, just maybe, it's actually a better thing to take that pension to preserve that and keep the longevity of those funds.
Yeah, you might not be financially disciplined enough to work with a lump sum here. You're just getting a check. And again, the options that you select is very important from a family perspective. A spouse, a surviving spouse, lots of decisions with this. So don't be pressured. That's the most important thing Danny and I can tell you. Don't be pressured to roll it over. Let an objective financial partner, a fiduciary, run the numbers for you.
So this slide talks about NUA, net unrealized appreciation. And you just mentioned energy stocks, and a lot of our energy clients certainly have the ability to do this. This is a great tool if you can use this and it's utilized properly. So basically, it's a tax strategy that's going to allow you to distribute the stock into an account, pay ordinary income on its cost basis, and then once you sell it, be able to sell it for capital gains. This is a pretty neat tool if done properly, and not all stock is created equally, nor do you need to utilize every share or every lot that you have in this process. Now, it needs to all be done all at once. When you do a rollover, you need to do this at the same time. So there could be times that you would want to delay, depending on tax years, depending on severance. This is something you want to sit down with a qualified tax professional, a certified financial planner, somebody who can sit here with you and help you make the best option and understand the implications, because there's a lot of financial implications with doing this, and doing this incorrectly could really hurt.
It could work out very well for you from a tax perspective.
Oh, it could be great.
Especially if you have a very low cost basis, which even though we've had a huge derail in many energy stocks, we have individuals that still have a very low basis.
That's correct.
So this could be a very good program for people to understand. But you're right. It must be done perfectly. And that's where we're very well equipped to understand it. Your tax professional, most likely the representatives at your employer are really good at this. But this is absolutely something that you want to consider. segue a little bit into some of Lance Roberts' charts that I think are very important, because the one thing I know about bears, they're sneaky bears. And what I mean by that is, you think the bear market's over. You think that it's the downside move is complete, and it's just at that time you get tricked. This is very indicative of how bears operate. So what we wanted to do is make sure you understand how bears tend to die or hibernate.
And this is really important, Rich, because I'm hearing from lots of different people, and they're saying, well, is now the time? I've lost my job. I think I have enough saved for income here, but I feel like now's the time. I need to get really aggressive to take advantage of these lower prices to kind of make up for lost time, or just to have a little bit of additional funds to live on down the road. And what we really want to make sure is that you understand how the bear markets work, and that you're going to get sucked back in and feel really good at some point. Maybe you're there right now, but that doesn't mean it's necessarily over. Now, look, we all hope it is.
I hope so.
But
It would be highly unlikely. Listen, we looked at bear markets here at RIA since 1928. We found if we look at each new period must be at least 12 months past the previous period, there are 15 bears. 9 of those made new lows. That's 60%. If you look at bears over the last 20 years, all of them have made new lows. We hope, to Danny's point, that's not the case. We wanted to show you what we're looking at here, because our job is to be realistic. Our job is to make sure that we just can't fall for it's over. We have to analyze the data and make sure to protect wealth. So bears tend to die on low volume. So just keep that in mind. We are going to see a surge in volume during the decline, but volume has fallen rapidly. On the upside. It's not the way it's supposed to be. This is one chart that shows us the bear market is not over.
So I think that's important. You know, you mentioned that volume has been extremely light on the upside, but usually you get that total disinterest in stocks when we're at the bottom. That's when we say, look, there's no more. I just can't take any more. I have to get out. I have to stop the bleeding. And human nature, we tend to do the opposite of what a fundamental investor should do, which is why how many people have you met with where you meet with the husband and wife and you're walking out and the wife pulls you aside and says, hey, Rich, we've never made any money in the market. And it's usually because
a lot, yeah.
We have that fight or flight instinct. And so when things are really, really bad, we think, oh my gosh, we have to protect our family. We have to protect the assets that we have. I just have to get out. Things are going to go away completely. And then unfortunately, we don't get back in until things are really good. And which is the complete opposite of what a fundamental investor should do, which is buy low and sell high. However, you have to be cautious on, is this a low? How do you catch that falling knife? And that's the problem. Most people want to catch that falling knife instead of making that pros and cons list and say, where does this end and how does this work? So hopefully these next couple slides empower you to make an educated decision on what's best for you. As humans and market participants, there is a 4-letter word we all fall for.
And it's not what you think. It's hope. Markets have a positive bias. We want to believe that the worst is over. You will see that reflected in stock moves during a bear cycle. We want you to understand that. And that leads to our next point.
Bears are tricky. They're not easy. They appear like you're going to have this recovery and everything's good, it's hunky-dory, and we've hit the bottom. But unfortunately, what that generally happens is that it sucks everybody back in and then spits them back out. And I know you love The Revenant.
I do.
And the scene there with Leonardo DiCaprio.
I wish we could have placed it in here, but if you're all eating breakfast, you may not have liked it. But if you've watched The Revenant and how many times that bear massacres Leonardo DiCaprio, it's the same thing. Bears are very tricky. And Danny has seen this. I've seen this. Lance has seen this. We're still getting calls from people who are anxious to get in, perceiving a market buying opportunity. Listen, at the bottom of a bear, I should be calling you, and you should be telling me, no, I don't want to get in. That tells us this bear is very tricky, and the bear market is not over yet.
And what will happen is inevitably we'll look back and say, okay, that was the bottom. And you're going to see, okay, maybe I missed a little bit. But if you missed a little bit, I mean, think about the longevity of some of these bull markets. Generally speaking, they last much longer than bear markets. So if you miss out on a little bit, it's not going to be detrimental to your overall health of your financial well-being and your plan. But if you get sucked back in and it spits you back out, that could be detrimental.
So what Danny brought up is very true. Generally speaking, you have more bull markets than bear. It goes back to my 4-letter word, hope. However, bears are damaging. They are incredibly damaging to your worth from a point perspective and how many years of investing or time that you've put in, because time is precious to you. So remember, bears are tricky. Listen, bears are tenacious. They don't just die, all right? We get calls all the time that the market's cheap. Well, the market right now, based on the Shiller P, is 26 times. That is hardly a bargain. There are 5 stocks that are moving this entire S&P 500. At the bottom of the Great Recession, the Shiller PE was 15 times. Now, I don't know if we get to 15 times this time. I think it's closer to 17, 18. Regardless, bears are tenacious. And there's the slide that sort of outlines how long it takes to break even, how extended we are.
You know what?
Mr. Roberts is just really throwing the kitchen sink into this one, hasn't he?
You know what I take from this slide, and what you'll typically see with most brokers or advisors is they'll say, well, look how long those bull runs are. And it's true. But what if you're at the top and you're retiring? What if you need to start taking distributions and you experience a 30, 40, 50% drop? What's the impact to you? And how long does it take you to get back to even? And especially now that you may be having to rely on these funds to live. Mm-hmm. Bear market damage can be inconceivable. Just like we just mentioned, the bear market of the Great Depression from 1929 to 32 was an 89% decline. Now, I pray and I hope that we see nothing like that here. We have many more monetary and fiscal policy tools than what they did back then. As a economy and people were very resilient. Technology has made life a lot easier in many different ways.
I can't even imagine what this would have been like without technology getting us through from a productivity perspective here in the United States, which is part of the Great Reset, right? How people are going to work overall.
It is. It's going to look a lot different.
38% is the average bear. That's the average. So if you look at the massive fiscal and monetary stimulus, and I don't believe we've seen the full extent of it yet, the best guess is you could have a bear market contractions somewhere between the Great Depression and Great Recession. Maybe that's a 40 to 45% retracement from the high. The time to break even, to Danny's point, is very precious. Your time. Now, I'm just thinking about if you're an accumulator. Say that you were advantageous enough or smart enough to put money into the markets at lows. Well, that's great because you may have 20 years. Although 14 years is a long time to just break even. I don't care if you're taking money out of your account or placing it in and don't need it to live. We want to help you understand that bear markets create a lot of damage, and you need to minimize that damage overall. So bear markets end on general price stability starts to return. Look at durables, look at autos, industrial metals, copper and oil. Oil is down roughly 60%. Baltic Dry Index off close to 65%. So you want low valuations, sort of a return to normalcy in the general price level, and that's going to give you the best opportunity for future above average equity returns. And we are not there yet. And this is just a chart showing you the collapse in these commodities. Now, we've seen a little bit of recovery in oil since this slide, but we have seen some amazing moves in the price of oil.
What we all must do now, and one thing we talked about, and Rich, you and I were talking about this last year, was creating a financial vulnerability cushion to give yourself even more leverage in times like this. So if asset prices are depleted, things happen, maybe you've lost your job and your car's broke down and the AC broke. You have that ability to maintain and meet all of those needs plus your general expenses.
So to break this down, funny thing, as I listen to advertisements on the radio for financial advisors, one of the more popular ones is out there touting cash reserves. These are the people that think cash is a bad 4-letter word. So now they're talking about it. The time to talk about this was months and years ago. What Danny and I created is you have a 3 to 6 month emergency reserve. That's for the minor stuff. Well, minor in the form of compared to a big life change, right? Your air conditioner breaks down, car breaks down, 3 to 6 months of living expenses. But Danny and I have been talking about having another 6 months for the financial vulnerability cushion, or maybe even longer, maybe 12 months. That's for the big stuff like we're going through right now. So even if you go back to work, before you even put money into your retirement account, make sure you have not only your emergency reserve, but your financial vulnerability cushion. 6 months plus another 6 months, maybe another year in cash. In cash. Very important.
Well, and the reason being is that we don't want you to tap your retirement savings. We want to have those funds continue to grow the way they are, or have the ability to do a Roth conversion, keep them in some type of an account that's not going to impact your taxes at the moment. Mm-hmm. Now, this can be a good time to reassess and reevaluate where you are, and maybe you do utilize Roth conversions, maybe you do take some funds out, but that needs to be done on a case-by-case scenario. Ideally, you want to have that flexibility and the stability of that financial vulnerability cushion.
Yeah, because we want to make sure you're not tapping retirement savings to live. And again, listen, we understand how much of the population can't raise $400. We know how the percentage of the population that lives paycheck to paycheck. If you have this financial vulnerability cushion, and listen, modern finance tells us that disasters happen every 1,000 years, but it's funny how they come along every 10. You need to be prepared for whatever job you're going back to is to build this cushion. Now, also is to work a temporary job to fill your gaps. There's no lack of pride in taking a job of any kind. Listen, I have a friend of mine who has just gone to work part-time at Walmart because he's got a cut in his hours and it looks permanent. He didn't care. He says, listen, a job is a job. Even if that's not the permanent job, the point is he's busy. His mind is working. He's learning some skills he really didn't have before, like maybe even human relation skills. Mm-hmm. So he's actually getting a lot from this job. So no job is beneath any of us. So if you have to work a temp job, go ahead and do that. And if you have to take advantage of the CARES Act because of a gap in your employment, by all means, do that. The tough one is make a decision to live smaller. Hey, listen, you might be forced. If you're going to get a 10 to 20% cut in your pay, I would tell you to assume that that's permanent, unless you find another job in a few years. And obviously, job mobility is going to be strained here, right?
It will be.
This is I can't stress it enough. It's an easy decision to say, oh, guess what? I'm not going to have a latte today. Big deal. Or I cut my cable bill. Great. I cut my bill. I put an antenna back on my roof. I've seen people do that. It's great. I'm talking about the big stuff, moving into a smaller place. Or I'm talking about these fixed expenses that you have that have been very challenging. Now, I don't know. Sometimes to sell a home today is going to be tough, right? So some of these decisions to live smaller are not going to be easy in the current economic environment. However, you can at least create a plan, a strategy of what living smaller looks like. A smaller footprint in your fixed expenses is going to be very important. What do you say, Danny?
And I think it's becoming easier and easier because we just went through the experience that we've been going through of, kind of being shuttered in. And so this allows many people to reassess what makes them happy. Mm-hmm. And I've talked to many retirees who said, Danny, my expenses are changing drastically. We're finding joy in the simple things in life. We started to reinvigorate ourselves with new hobbies or old hobbies we've picked back up. We're going on walks on a daily basis. We're cooking together to eat healthier. So I think there's a number of things you can do that actually make significant impacts on your budget. I think we run a pretty tight household in my home. And we've even noticed by not having the ability just to run to the grocery store, or not wanting to, that we've had to make it work. And now maybe we're not eating the meals that we always want, but we're making it happen. And there's many ways you can do that to really batten down the hatches, preserve what you have, especially in times like this, that, look, we're going to get out on the other side of this thing and things are going to be okay. But we want to make sure you're armed with all of these things and know that making these decisions, it's okay. Set your pride aside. This is about you, your happiness, your family's happiness, and your financial well-being so that you're not in this rat race forever.
That's to Danny's point, reassessing your life and what makes you happy. I'm hearing so many great stories through this. How families saying, listen, every Saturday we've been running around to soccer and paying for all this stuff. We don't want to do this anymore. We want to spend more time together. We want to cook. We want to Danny, as you mentioned, Danny, right, working with what you have. In addition, I will tell you, one thing I'm very concerned about, all these discretionary expenses we've taken for granted, like going out to eat, for example. Listen, restaurants are going to have supply chain issues. Costs are going to go up. They can't have as many tables occupied. What we were considering just day-to-day stuff pre-COVID may now be luxury. So reassessing your life and what makes you happy outside of spending is going to be very important. And that's where your budget comes in. And I know it's like telling everybody to eat their vegetables, but really keeping a micro budget. I have people that have been doing this through this hibernation, really tracking where their money goes. Even if they say, listen, Rich, we don't have to cut any spending. It's really good to know where our money is going. What are these auto payments we have that are going on? Do we need these things? And I have people that are cutting all kinds of stuff. It's not going to impact their overall net worth too much, but man, it's such a sense of empowerment to do this. That is so important. Also, learning a new skill. We're going to provide some resources for you. We're just going to go through the slides real quick as we do that. And also eat healthy and maintain an exercise process. And I know this sounds weird, but health does equal wealth. Danny, how many shows have we talked about this, that we equate money with health? And that keeping your health is going to save you tremendous amounts of money, not only in retirement, but before. Such an important issue.
And those are two things that typically go hand in hand for a couple of reasons. But one of the big reasons is that it's not easy. The easy way out is to go pick up that donut on the way to work, to go eat the burger, to continue, bad habits, which, look, you can't deprive yourself by any means, but you need to do things in moderation. And the same thing goes for your finances. And that's why so many times they're intertwined, because I think some of those same habits go back and forth. They're interchangeable.
Some of these habits might be forced upon us because of less cash flow, right?
That's right.
So what Danny and I want to try to do is, yes, this has been a horrible thing, but we want to show you, listen, there's light at the end of the tunnel, but you have the flashlight. You're the one. And believe me, you're going to hear a lot of stuff from modern finance that's like everything's going to be fine and you just go back to doing the old stuff. Listen, don't listen to them. Listen to us. We want to make sure you're doing the right things. Again, these look simple, but what I would love for you all to do is take each one of these bullet points, create a page, pen and paper, and write out what it means to keep this budget. What are you looking for? If I want to reassess my life and what makes me happy, take a self-inventory. I'm not trying to be corny here. I'm just trying to help you understand that you have time. We've seen gardening become this great family activity, right? You go past a garden center and it's packed. And I understand that because it's healthy and it's different than what we've done before. And we're not running and rushing from one place to another. And people are saying, I didn't even spend any money today, but I had a great day. Right?
Yeah.
I mean, this great reset, there are going to be some very cool things that come out of it. We want to help you discover those cool things. So what we've put together for you in bullet point form are resources that are available to you for new skills. So there's EDX, Allison, 1,000 courses. Oh, man, just anything you want to take here. Coursera. Hundreds of courses for free. I don't know how many courses you've seen on Facebook, Danny, but there are a lot of creative writing courses from universities that are slashing prices. Babbel, which is the language courses, they're charging $159 for a lifetime membership to learn any language that you want. So I'm saying these courses are available to you for lower costs. So I want you to go through these resources and see what fits you, because you just might need a whole new skill set in the Great Reset. Codecademy, free coding classes, 12 different programming languages. So those are the ones that we like the most. There are hundreds out there. We could be here all day. We just want to help you understand is learning is a lifelong process, and maybe you always thought about getting to it. Now's the time to get to it. So this is how you contact us. We answer emails. We call people back. We want to give you practical advice to get through this. There are a whole series of webinars we're going to have coming up for the Great Reset that I think are going to be very helpful to arm you to be better financially through the Great Reset. We want to make sure that we're the people you turn to because we're already reevaluating how we do planning, the process of Social Security, guaranteed income, managing your budget in the trenches, not from some tower, but there with you.
Yeah, thank you for joining us today. We'd love to hear any feedback you guys may have. If you have something that's personal, really hits home, and you want to talk one-on-one, as Rich said, please reach out. We'd love to be a resource to help guide you through this madness that's happening now. We're going to be doing more and more of these, so if you have any topics that maybe we didn't cover that you'd like to hear, please let us know. So I'm Danny Ratliff, CFP. Thank you guys for joining.
And I'm Richard Rosso, Certified Financial Planner. We so appreciate you being with us here today.